So I'm going to talk about these two papers and the research lines in general that these authors have been working on. First, I want to start with a disclaimer that I'm not an expert in ESG investing, and my focus, my research expertise is in consumer financial behavior. So I just want to say that unlike Chris and Roberto, this is not my main field. But I did learn a lot from reading their papers and reading some of the literature on this. And thanks for that the opportunity to do that. The outline of what I'm going to say is, first of all, I just want to ask the broad question of how costly, if at all, is ESG investing. I want to then focus in on something that Roberto touched on at the end, and looking at the difference between the effects of ESG investing on stock prices and stock returns that come out of a two-period versus a three-period model. It turned out to be some important differences. We'll talk a little bit about modeling measurement error as it applies to Roberto's paper. And then finally, I want to end up with a brief discussion about ESG for individuals, and in particular the role of direct indexing, which I think is a really interesting future for this, for ESG. Okay, so to start with, is ESG investing costly? And there are a few different kinds of costs one could have here. One is just the cost of screening. So the actual cost of the rating agencies to come up with the ratings, and then also to implement that in screening. So there's those kinds of costs that are going to be there, and that will lower, raise expense ratios somewhere along the way, and therefore lower expected returns potentially. The second one is, even if there's no price impact, in other words, even if ESG investing doesn't affect stock prices at all, there's the potential cost of reduced diversification. So you just screen out, a quarter of all stocks, for example, or downweight a bunch of stocks. You're going to have a lower Sharpe ratio from the reduced diversification. That effect is probably relatively small, because we're talking about, especially if one has a large portfolio to start with, that if you downweight or eliminate a relatively small set of those, you're still going to get a lot of diversification out of a large number of stocks. So that effect is probably relatively small, I think. And then, even without no price impact, there's the potential to screen, to pick up companies possibly that will be more successful in the future. That's the kind of win-win scenario, right? If it actually turns out that there's some factors in ESG that are related to ESG that actually predict higher future cash flows for the firm, unrelated to the price impact, that's a potential source of win-win. Of course, you could try and do that and do worse and end up worse off, but that's a potential way to have non-costly or even beneficial ESG investing in terms of returns. Now, in addition to these models with no price impact, one could have price impact, okay? In which case and I'm going to talk in more detail about that, but in which case, if there's a lot of demand for ESG firms, that's going to raise their stock prices and potentially therefore lower their expected returns. So I'm going to spend a little bit more time talking about that. So let me start with the standard two-period model of stock prices and returns. And in that standard model, the current stock price depends on the demand for stock by current ESG investors. It also depends on how sensitive that demand is. The demand is by non-ESG investors, right? So if non-ESG investors are very sensitive to demand, then when the ESG investors get out of a company, say, the non-ESG company is just going to jump right in. They're going to, and you wouldn't expect to see that much of a price impact. But if the sensitivity is not high, then of demand by the non-ESG investors, then you would expect a larger impact. And so generally, this is going to imply that highest ESG rated firms are going to have higher stock prices and vice versa. Now, in this case, if the stock price is higher for a high ESG firm, then the future return is going to be lower. In this two-period model, there's a one-to-one mapping between the stock price and the expected future stock return. Okay, so it drives down the price, the current price, the future price isn't affected. Therefore, you're going to get a different, when current stock prices are low, implies that future returns are high. And so this one-to-one mapping that's there in this two-period model. If we expand things, however, into a three-period or longer model, then things change. And I've highlighted in red the things that are different. So now, when you think about multiple periods, the stock price is going to depend not just on the things that it depended on the two-period model, but also by expected future demand by future ESG investors. Okay, so we have to take into account what the demand is, not just today of ESG investors, but what the future demand by ESG investors is going to be. That's going to also influence today's stock price, and perhaps more importantly, it's going to affect the future stock returns, right? So the future stock returns, again, depend on the current stock price, just as it did before, because if the price is lower, the expected return is higher. But now we have a bunch of other things that matter for returns. We have the future ESG ratings. We have the future demand by future ESG investors. And we have the future sensitivity of demand by the the future non-ESG investors. So it gets a lot more complicated. And what it implies, however, is there's no longer a clear mapping between today's ESG ratings and your returns from today into the future. That mapping was clear in the two-period model. It's no longer clear in this three-period and longer model. And let me just elaborate a little bit more that current highly rated ESG firms could have even higher relative ratings in the future, which would mean that you'd actually get a positive return on those. The demand for high ESG rated stocks could increase in the future, just because there's a lot more ESG investors, for example, or they could be more aggressive in their investing. So the future demand could increase, which would also raise the expected return on high ESG related stocks today. And so as a result, it's possible that high ESG rated firms could have higher expected returns and higher actual future returns, which complicates the whole analysis. So I think in order to use this to guide the empirical work, we need to think more about how responsive will low ESG firms be in the future to today's pressure, right? Because that could change the future ratings as well. And also, how popular will ESG investing be in the future? And that can also influence this mapping. So I think these are really important things that will inform the empirical work, really, that both authors have done, both Chris in his paper and Roberto in his paper. Okay, the other thing, next thing I want to talk about are these noisy ESG ratings. And Roberto and his co-authors rightly highlight the big differences across ESG ratings and talk about some of the sources of differences. And there are lots of implications of this noisy ratings for measuring the impact on returns. And I just want to take one minute and talk about modeling measurement error. Roberto assumed classical measurement error, and he also that the error is uncorrelated with the truth, and also assumed that investors know the truth and base their investments on it. But those are not the only assumptions one could make. One could look at the rational forecast error model, that the error is uncorrelated with the signal rather than the truth. And you could also assume that investors don't actually know the truth, but they base their investments on the inference from the signals. And this is going to have implications for the results. There's an old paper I did, too old, very old, but with Jeff Myron, looking at this issue of differences in measurement error and the different implications for the tests that are done. And I encourage the authors to take a look at that issue. Finally, I just want to make a pitch for the role of direct indexing in ESG. That's where there's a customized index that tracks through direct ownership of a large number of individual stocks. It's a relatively recent phenomenon that's grown in importance recently. It has the advantages of You can have very flexible ESG screens. There are tax advantages, at least for taxable accounts. And I think most importantly, but one that's not highlighted that much, is voting rights. And especially on these ESG matters, the opportunity for individuals who are doing ESG investing to actually weigh in on the votes on how their shares are voted, which they cannot do in mutual funds, I think is really important and a potentially big thing in the future. So some examples of this include a Peria, which was purchased by BlackRock. It includes Parametric from Morgan Stanley. Ethic is another one that's doing this, and Open Invest is trying to do this for ESG for individuals. So I think this is an important development that could potentially affect how people as individuals invest, and potentially also how returns, prices, stock prices and stock returns, as well as voting patterns are affected in the future. So thanks.